I've listed some of the most famous splits I can think of. I list them alphabetically as well because, well, frankly, I do stuff like that. We got atoms, bananas, divorces, gymnastics, and stocks. Well, we're not going to talk about bananas or gymnastics on this call. We're going to talk about stocks, stock splits. An example of a stock split is we have a stock that's maybe trading for $100 a share and it does a 2-for-1 split, and now you have two $50 shares. Now, why would a stock split? Well, I'll give you an example of a stock that I own that split numerous times. A company called Harley-Davidson. I bought it for $8 a share a week after it IPO'd back in the mid-1980s. The stock went up in price to around $80 a share and then split 2-for-1, so I had two shares that were $40 a share each. My cost also split to $4. The stock split again, and now I had 4 times as many shares at a cost of $2. It split yet again. I had 8 times as many shares at a cost of $1. It split again. I had 16 times as many shares at a cost of 50 cents. It split yet again, and I had 32 times as many shares as I started with my cost basis at 25 cents a share. I just soon buy an option for 25 cents a share because this took decades. The reason the stock split is because the stock kept going up in price. It reached a peak. Here we're going to talk about stock splits and more specifically about an option split. You see, when a stock splits, so does its options, right? Just like I was sharing that the cost basis per share split, well, an option splits when the stock splits. So same example, if we have a $100 strike price, now we'll have two $50 options. As always, I made a prediction that stocks with certain criteria will have options double almost every expiration week. So what are those criteria? Stock that moves enough in price that an out-of-the-money option moves into the money should double. And so we have a determining factor. What's the stock's price and what are the strike prices? Right? We have dollar and distance. How far are they apart in both price and percentage? Here's an example. Here's Baidu from a long time ago. Strike prices were every $5. 80, 85, 90, 95, 100, 105, 110, 115. Well, $5 on a $100 stock is 5% away. The further the strike prices are from each other, the lower our gamma success will be. The closer the strike prices, the higher return, the higher possibility of gamma setups, right? And a gamma setup is where we get an option to double or better. So here's FAZ when it was a $8 stock. And we can see that the low of the day was $8.21 and the high of the day was $8.81. This stock moved 60 cents. 60 cents was roughly 7% of the stock price, and it never moved over or under a strike price. If Baidu that had $5 strikes moved 7%, it absolutely would have crossed a strike price, maybe 2. Here's a stock, moved 7%, and it never crossed a strike price. When a stock splits, its cost basis splits, its option split as well. There's a thing called a reverse split. Used to usually be used to raise the stock price to avoid a delisting of the stock. An example being, let's say an exchange says a stock has to trade for more than $1, and the stock goes down to 80 cents. Well, if it doesn't get over $1 by people buying it, it's going to get delisted, so they do a 1-for-2 reverse split to get it to $1.60, which tends to be over $1. The problem with this, sometimes it's the kiss of death. Now the stock just goes from $1.60 above $1 to back under $1. And we're not just talking dollar stocks, right? In previous years, a stock had to be over $5 for it to be marginable. And so a stock might go under 5, and they might do a reverse split so that people can own it on margin. I call this the kiss of death. right? I also called it the suicide split because stocks that did a reverse split tend to trade lower as there's more room for traders to short them. I jokingly said, if a company does a reverse split, run, and run like Godzilla is chasing you. The mechanics are different. As opposed to receiving more and more shares, you receive less shares. Here's an example. FAZ did a 1-for-5 reverse split. Now the shares at the time were trading near $8, and you had to have 5 old shares to get one of the new shares. Right? 5 shares at $8 became 1 share at $40. This was the suicide split. But instead of killing the stock, it gave a breath of life. And I call it the X factor split. Right? Remember that X factor is the difference between a stock's price and the strike price. If FAZ were to move 7%, it would cross through strike prices. And I like to consider that X factor is the ease to increase the intrinsic value of an option. Again, the concept, we want to buy an option that's out of the money when we buy it and sell it when it's in the money. We're trying to increase the intrinsic value. That's the amount in the money. X factor is where an out-of-the-money option goes in the money, or an in-the-money option goes more in the money. $40 call on a stock that's $39.95 will have $5 cents worth of intrinsic, and if the stock now moves a dime, we're gaining more and more intrinsic. So we're looking for options close to or near the money. Remember that at-the-money options have the highest gamma, but a near-the-money option, while it doesn't have the highest gamma, it's got a high gamma, but its time value is lower because at-the-money options always have the highest time value. Right? Not some of the time, not most of the time, but always. That's what makes this system work. The rules, laws, and math and logic that's attached to it should generate positive returns. We're going to look for a slightly out-of-the-money option that becomes in the money. Now, here's another example of the X factor split. Citigroup, right? Ticker C. I've been trading this a long time. I always gag. I want to say Chrysler, which used to be the ticker C until they merged with Mercedes-Daimler. But Citigroup is C. Now Citigroup was trading around $4.50 a share, and they did a 1-for-10 split. So 10 shares at $4.50 became 1 new share at $45. The advantage that the strike prices became closer as a percentage. Well, $40 is as far away from 4.5 as $40 is as far away from 45 as 4 is from 4.5, except they added new strikes. Now, on the top half of this table, we show the old strikes, the 4, 4.5, right? 3.5, 4, 4.5, 5, 5.5. Well, 4 became 40, and 4.5 became 45, but they added the 41, 42, 43, and 44 in between. Those strike prices are closer to the stock price in most situations. It increased the X factor, right? X factor strike creation. The 41, 42, 43, and 44 would be the equivalent of a $4.10, $4.20, $4.30, and $4.40 options. The reverse split that Citigroup did was a fabulous thing for us for penny-wide priced option trading. Here's an example. On May 16th, we have this option move from 30 cents to 38 cents. This is the $4.50 put. Now, if it were the $45 put, we would anticipate it moving from $3 to $3.80. Now, $3 to $3.80 you can make some money on. Now, you might say, well, $3 is 10 times as much. But you know what? Let's quit buying one contract. Now, we're going to talk one contract all the time, but at some point in time, please put more money to use. Here's the $4 put pre-split. right? It went from 1 cent to 2 cents. I guess you could buy it at 1 and sell it at 2, but you're going to pay too much commission. It's really not going to work. Here's the $40, which is 10 times. It went from 12 cents to 29 cents. See, there's a rounding error from 1 to 2 when 12 cents is like the one with 1 step further past the decimal, and 29 is like the 2 with 1 step past the decimal. There's absolutely room for a double here. Now, what gets better is the precision that we can trade. We had the $4 and the 4.5. Now we have the 40, 41, 42, 43, 44. Well, specifically, let's look at the 42 here. This option opened at 64 cents. Excuse me, traded for a low of 64 cents. It traded to a close of $1.02. That's not quite doubling, but it's tradable. So I'm going to have a weekly prediction for Citigroup. Now that the strike prices are closer, now that the range as a percent of the strike prices is better, Citigroup could have an option double every week. Well, there's a couple things that I don't like about it. Its average range is less than the strike differential. What does that say? Well, average range is the difference between the high and low, the average of a number of days, right? It's less than $1, even though the strike prices are $1 apart. So it's not telling us for sure that it's going to cross a strike price. So it's not telling us for sure that an option that's out of the money will go in the money. It'll happen often, but not all the time. So pay attention to Citigroup. It should be on your short list, not necessarily on the top, unless the chart or other extenuating circumstances tells you it should be. It's a good trade, but without this suicide split, it was off the radar. So let's review. When a stock splits, so does its options, either direction. Reverse split review. Oh, did I spell review wrong, or is this a circus? Hey, a reverse split is a kiss of death, but with X factor options, it becomes the breath of life. Right? The reverse split stocks have strike prices that are closer as a percentage to each other. Now, I still get concerned about stocks that have a reverse split, and there are some disadvantages to it. One is the odd option look. This generally will happen if a company does a 3 for 2 or 2 for 3 or some odd number. When the split is by 1, right, if it's divisible and can go into 100, the options kind of feel okay. But when we do these odd splits, we get an odd option look. And the other problem when a stock does a reverse split, it's got further to fall. Why did they do the reverse split? It needs to beg a question, right? And your answering these questions are what's going to improve your trading.